Ladies and gentlemen, good morning. I'm not going to do the usual this week after last week's price action because I'm not going to even pretend that I know what is going on, because I don't think anybody knows what is going on. I can just tell you what the facts are, and then we can try and interpret them together and reach the most probable conclusion. Here you see our risk on off model, which will be on our new website, which I will launch at some stage next week when I've completed it. As you can see it from the scoreboard, it turned the daily model to risk off, i.e. from equities into bonds on the 11th, and it turned the weekly model last Friday from equities into bonds last Friday. The monthly model, which has a 20% allocation, the same as the daily, will most probably turn on at the end of the month, but we can't possibly know that as yet. But what I'm saying is chances are it will turn as well, and it'll be the first time that all three models, daily, weekly and monthly, have been in a risk-off position for many years. Okay, so this is what is going on. As you can see, the moving averages of the scores of the daily model have crossed and given very steep sell signals. If you can see where we are at -21 on the scoreboard, where last time we were at -21 was sometime in late 2015, and then we had the panic of 2016. So that is the kind of setup we're in. We're in a much worse position than we were in February. In February, the model never really went down, and because the spreads were still all pointing upwards and saying that we are in risk on. Now they're all pointing downwards and that we are all in risk off. There is no point in me showing you all the spreads because they are reflected in this score. We have some way to go towards -100. I think the model was -100 only for a few days in late 2008 before it turned. -100 is the world is ending. But even being underneath zero is a very it's a situation that we haven't seen basically since late 2015. So 3 years of this kind of situation that we have not seen before. What has happened though in the meantime is also the allocation model, which allocates between S&Ps, 1 and 3 year bonds, long bonds, 20 years plus, TLT, gold, or commodities, switched into bonds, i.e. risk off, I don't want to know, get me some duration and leave me alone, also on the 11th of this month. So it caught it very nicely. What happened at the same time is that we got counter trend buys from all the counter trend models, which in bull markets tend to catch the bottom extremely well. These green dots are where the model has caught the lows in the past, and you can have a look at all of them. Now what is going to happen is that the last model, which is long, is this one, the RSI strategy, and it will dump its position on the close of Monday, whatever the close of Monday happens. Why is that important? It's important because then we will officially, on this model, which basically is designed to mimic the way my brain works, will be in risk off. Does that mean that we will necessarily fall apart? No, it just means that the market is going to have to prove to me with facts, with price facts, that it can sustain rallies. and that it can make higher highs, and that spreads can be repaired, because at the moment these spreads are not being repaired. Every rally that we have seen has actually made no difference to the score of the model, and that means that the spreads have not been repaired. If you look here at the daily scores, you will see that we have been, each day we're minus 21, minus 15, minus 21, minus 11, minus 3, minus 5, minus 5. So basically, the model has not seen a positive score, even though we had huge rallies in the meantime since the 18th of this month. From the 18th of, so that's been 2 weeks of trading. The model has been doing nothing but deteriorating, deteriorating, and deteriorating, and now we are as bad as we have ever been at minus 21. That is significant because that is something that we know. We know that all the models spreads, and we look at all the risk on, risk off spreads, hundreds of them, are all saying this is something that is very significant, and it's something that is likely to last, i.e. we are unlikely to get a V-shaped recovery. If we do, the model will be whipped, but it will reflect it. It will very quickly go back to risk on. At the moment, there is no sign of it. And now let's go and have a look at some charts and see what also we know and what also could easily happen. Fact number one that we know is that the S&P has liked the times 15 forward earnings Blue Angel for decades. Ever since basically the 90s, the market, unless the forward earnings, unless the slope of these lines was downwards, it has liked being at the times 15 as a support. That support, as you know, is around the 26-25 area, and that is basically why we bounced on Friday, I feel. The bounce was vicious, but the counter move was also very vicious. I never expected to get filled at 42 to 48. I really didn't. I didn't think the market had it in it. It did. I was fortunate. I was able to make nearly 20 ticks out of it. But to me, a market which bounces so little and has so much, I don't know, so much venom on the downside is very, very odd. I expected a much quieter session once it bounced off the times 15. I expected the market to realize that there are real cash bids down there and basically trade in a 1.5 to 2 percentage points above that level, so 40-50 higher, i.e. 60-70, and calm down. Coming back down into the low 40s to me was a bit of a sign of weakness, but that doesn't necessarily mean anything. That's not something I know. It's something that I was surprised by. So even in 2007, when we had very, very similar spread conditions to these, i.e. the model was saying we are in a risk-off period, the S&P still kept on following the 15 times Blue Angel, kept on bouncing between 14 and 15, 14 and 15, until these Blue Angels finally turned, and when they turned, goodbye Irene, it was the end of the world. So if the 15 times doesn't hold it, God help us, because we will go down to the 14 times. And the 14 times is what? Below 2500, 2470. That to me is very possible if the times 15 line doesn't hold. And it's simply because we don't know why things aren't holding. To me, it's not the US that has a problem. To me, it's the world that has a problem, because every other market, i.e. Europe, Asia, emerging markets, whatever you like to call them, has shown incredible weakness in spite of US strength. And now probably the US is catching up. Why is it catching up? We don't know the answer to that, but we must respect what the market is telling us. The market is absolutely telling us that something fundamental is going on, and there are some real sellers of cash, real cash sellers, because I expected the market to rally at some stage last week into 2800 to buy some puts. It never really did. It was just weakness from the off, which to me indicates that there are some real cash sellers. If we now go to what yields are telling us, this is a daily chart of the 10-year. Well, okay, we've had a little ABC correction, but this is hardly impulsive, is it? I mean, this is hardly this kind of move. It could turn out to be that kind of move, but it's just not. We have the 200-day moving average well sloping upwards. We have the 50-day moving average sloping upwards, price above both of them. This to me at the moment is nothing but a market which is slightly retracing the move that it made from August onwards. This is not something which is falling apart. These yields are just in retracement at the moment. It could turn, but at the moment they're just in retracement. Does that mean that we bounce in ES? Possibly, but I'm surprised that all this weakness in ES, this 10% move that we've had to the downside, has basically moved 10 years from 325 to 307. In the good old days, it would have done a 50 basis points move. Not much, right? If we look at the 30-year, it's even more surprising because on a weekly basis, it's like we've done nothing. We've gone from what was the close before, 338, we've gone to 317, 318. That is almost, a week which didn't, in which nothing happened. All it's done basically, it's alleviate and allowed the market to basically stay within the Bollinger Bands on the weekly, and basically bounced off this line that we keep on telling you that it's very important, which is 341. So it's now trading between 322, which was the break, and 341. Big deal, right? But if we go to the 5-year, here it's much more pronounced. Here we have a much more pronounced breakdown, and also it's barely hanging on to the 50-day, and I would have thought that it has a very good chance of coming all the way below 280 to this 76 to 78 point fib and test the 200-day moving average at some stage. What is that saying? That is saying that basically the yield curve is steepening, just as we said it should. People are parking money in the short end, the shorter the better, and nobody is buying 30 years because nobody really wants to park money for 30 years. Now the only question that we have is, are people parking money in the short end because they want to redeploy it into equities, or is it because they don't know what the hell is going on and they're getting into equities and they're buying what they need to buy? So I am going to just basically stay with the charts and show you what else we know, and let's see if that gives us any conclusions. The other thing that we know is that the dollar failed on a weekly basis to hold 96.50 and closed back down, and now has a chance, I guess, if it won't go up, it'll go down. I would have thought that at some stage during the week we test this 95.20 area in the dollar. That's a guess. That's not something we know. We know it didn't close above 96.50, had a fantastic chance, failed at the last. I was all ready to buy some call spreads because that's my favorite way. Uh, it didn't happen. I'm not bothered. I'll buy them some other time. At the moment, the dollar is not rallying, so that is something that we know. If it breaks 96.50, we will know it. And the fact that the dollar isn't rallying, to me, is a sign that the other markets aren't going to be as stressed and there won't be as much selling, and therefore I would have thought that even ES might catch a bid as a result of the weaker dollar. Next, we should look at a weekly chart of the S&Ps, and I'm just showing you this because we closed well below the daily Bollinger Band. The weekly Bollinger Band would have been somewhere around the 2690s. Well, we bounced the first time, and then we just collapsed through it, made a very imposing new low, and now we closed still below the Bollinger Band. Every time that has happened in the past, we have had a continuation downwards rather than a move straight back up. But it's important to see where the levels lie now. This yellow line will come down probably to around the 27.25 area. 27.25 also happens to be the point of control of the whole of 2018. So 27.25 is going to be very, very important to the upside. Only when we can rally above 27.25 I will start even thinking that this is over. We could easily now on some kind of a complete panic go down and test these lows, which are all the way down in the 25.50 area. It's entirely possible, but you can see how the situation is entirely different between February, when all we did is we came down and tested this blue last moving average. We stayed well within the Bollinger Bands. We were just correcting then a ridiculously overbought situation, but now we are actually turning all these moving averages and making them go negative. So it is reflecting what the model is saying. The model is saying we are in risk of sell bounces. And the most important bounce, the first bounce, is going to be somewhere around that 27.25 area. So that is the first level that I'm looking to see where how the market will behave. If we look at a monthly chart here, the situation is becoming almost tragic. If we have a look at the support, here is the support at 20 that we touched on Friday. The last level of support on the monthlies, this moving average, and below we have a chasm all the way down to this moving average and the lower Bollinger Bands, and that comes in 23. I mean, it's a long way. It could be panic. Now, what is also very, very amazing to me is that the MACD is most likely going to cross at the end of this month. We don't have the closing print, but we have a negative probable close on the MACD, and we also have an RSI divergence insofar as this point is higher than that. So it could be signaling real trouble for the market ahead. And that is something that we yet don't know, because next week we will close and then we will find out where we are. But at the moment it's looking very, very indecisive. And again, if this moving average is turned, i.e. we close down here and we've turned this red moving average, every time that's happened, we've had continuation selling, as you can see here, back in late 2015 and early 2016. I wanted to show you a 10-minute chart just so that you can see the slope of all these very important moving averages. All the market does ever since it turned them, basically on this would have been Tuesday, it has been, sorry, this would have been Monday, Tuesday, Wednesday, Thursday, Friday. They have been coming down and we are in a downward channel. We break it a little bit on the downside, rally back up to the moving averages, more selling comes in. This is why I think it's important that you understand that this is to me it's very important that there are sellers on every rally. Before we had buyers on every dip, now we have sellers on every rally. The market rallies when it's extremely oversold, and as soon as you get to the moving averages, there's a wall of selling and the market goes down. So without a doubt, there is fundamental selling of equities going on. The good news actually is on the dailies, where we have a divergence now, a positive divergence in the RSIs, that we made this low coincides with this RSI print, and the low on Friday coincides with this RSI print. So we are actually having a positive divergence. The volume on Friday was nowhere near as bad as the volume on these falls. That to me actually says that what we have done is we have bounced off the fibs that we should have bounced off, and that actually possibly we could actually try and get back up towards 27.25 in the early part of the week. Again, should we do that, and that takes 2 or 3 days, and these moving averages are all turned, including the 200-day, which is beginning to keel over, this is going to be extremely, extremely bad news. So 27.25 is going to be almost the be-all and end-all. If we can't hold it, this divergence will no longer be in play. The monthly candle will close where it, below all the moving averages. The monthly stochastic will give a sell, and that will be a very, very bad sign. Now, I am not a believer that this has anything to do with politics, anything to do with the midterms. The market, I don't think, cares if the Democrats have 10 seats more or 10 seats less. It's not that significant to the market. To me, there is another reason. We don't know that reason, but the reason will become apparent in the weeks and months ahead. Whether that is a collapse in some Asian country like China, whether that is a global slowdown, I think the market at the moment is anticipated something, because it is almost inconceivable to me that all this selling, all this fundamental selling, would take place just because of some election in the States. To me, that is just a too far. Had the selling stopped here, yes, I could have understood it, but this is just too much. I mean, we are off a good 10% from the highs, and nothing has changed. The earnings really haven't been, bad at all. They've been very, very good. So to me, it is worthwhile buying off 26.25, looking for 27.25 and the reaction there, and hopefully we spend some time here, and slowly through time, by trading in the middle of the range, we actually turn these moving average and then we can go higher. But it doesn't look like it, certainly not if we don't do it in a hurry. I think it's also important to have a look at some of the leaders of the rally, and this is Amazon. We closed below the 200-day moving average, but we are holding into the Bollinger Bands. I'll enlarge this for you. This is, to me, the fact that we've closed below the 200-day Bollinger Band means nothing. I would like to see the Amazon bottom around 1501, because then I'll be quite happy to say that this was an ABC retracement with A equals C, and then we can probably have a decent bounce. But what I'm saying is that even Amazon at the moment is not nowhere near as bearish as the market overall. But it's the problem is that it has positive RSIs, so I'm quite encouraged that we will see a bounce in Amazon towards 1750 again at some stage. But it's all coming down to the performance of very few stocks, and Apple is the most important. If you look at this one's done nothing wrong. This one's in a very good position to make new highs, and we have Amazon earnings on the 1st, I believe. So it's going to be very interesting to see next week what the market does. My expectations would be for a range between 26.25 and 27.25, and then we are in the lap of Apple. If Apple misses or they sell it afterwards, that 26.25 level that is so crucial on the downside is probably in danger, and we would fall all the way from these levels. The 213 we'd break, and we'd probably go straight down to the 200-day moving average, which is in the low 190s. That would be a good 10% move, and that good 10% move together with sentiment is enough to take the S&P probably down 3 or 4% or even 5 additional percent without too much problem. That is another 100-pointer in S&P, so the low 2500s are in no way out of the question if Apple decides to do that. XLK on the whole is actually doing quite well. It is below the 200-day moving average, relatively well compared, and we do have these positive divergences on RSI, which should encourage the market to at least test the 200-day moving average again. That to me is around the 70 area. There I would no longer be bullish, but all that means, that's like in S&P terms, what is that, 27, 25 max? So that also has that area around 2700, 2725 as the important area, and this chart is probably saying we don't cross it. Nearly 50% of the S&Ps is XLK and XLY, the discretionaries. And as you can see here too, in the discretionaries we have a positive RSI divergence. The market XLY seems to be weaker than XLK. To me that is just we will go back up towards 107 and a quarter and test there and remain below the 200-day moving average. Again, that is equivalent to a bounce, I would have thought, to that 2700, 2725 in the S&Ps. It's going to take some time to prove to me that it can crawl back above the moving average and these highs which it made here back in March and early April. It's unlikely that it's going to do it, but to me this is also a chart which is saying that it's not really ready to go down yet. My final proof is actually the VIX. The VIX has gone higher all week and actually closed completely unchanged from Thursday, even though the market was significantly lower. It did make a new high and the RSI didn't, so we do have a bit of a divergence. The VIX could easily come back down towards the 22 area, but that 22 area is actually where we were around the 1700, 1725. So it all points to the same. 1700, 1725 should at some stage next week trade. But when it does that, it's turned the 200-day moving average. The 50-day is about to move above the 200-day. So any dip back into the low 18s, high, sort of mid 17s, where the market was when we were trading 2800, is going to be a fantastic buy, because we do have a yet another leg at some stage, I would have thought. The big question for me is, where is this money going? Okay, so there's fundamental selling of equities, which there quite obviously is because of the price action. Where's that money going? This is daily chart of DBC. Is it going in DBC? Is it going into commodities? No. Let's have a look at a chart of gold. Is it going into gold? Well, ish. Okay. I mean, gold last week went from 127 to 135. Is it going to gold? Well, I wouldn't say it's going into gold. A little bit, some small percentage is being parked into gold, but this is hardly a very bullish chart with the 200-day as negative as it is. So if the money is not going into commodities, it's not going into gold. It's definitely not going into the Swiss franc. The Swiss franc has been weaker all week. Where is the money going? And it seems that the answer is that the money is going in the 2-year. This is a daily chart of the 2-year. Basically, it's being parked in cash. So really, it's being parked in cash. Short-term cash is the only thing that has done significantly better last week than the week before. That is a sign of complete indecision to me. I don't know what's going on. I'm going to get out and I'm going to just put some money, on deposit, or 3 months or out to 2 years, whatever. But that to me is it's people waiting to take a decision about the next step, and that could be very, very violent when it happens. So my final thoughts are, the market is going to trade between the lows of Friday 26-25. If it falls through them, God help us, because there's nothing, there's air underneath. That's why I think it's important to do it as call spreads as opposed to put spreads, and really watch what it does around 2700 to 2725 if it still can't hold those levels, and more importantly, if it can't start turning these moving averages, these very short-term moving averages, positive, that is going to be a very, very bad sign. Before we start having any kind of rally, these very short-term moving averages need to give us the floor. And what I would expect is a market which whips around 2640 and 2700 for a couple of days, allows these moving averages to turn, and then goes up and tests the 2725 area, this level, this kind of area here, 2725, 2730, where we bottomed around the first leg. If it goes through the 2625 area, takes out this low, then I really don't know what's going on. That's the times 15 Blue Angel. It's the 0.718 retracement of the whole move up. It's such an important level that I think the market is probably just going to have, a cascade below it. The one market that I will be looking at very closely next week is going to be transports. We're very close to the 0.382 retracement of this entire move from 2016 or late 2015 up into this month. So if we now start breaking down below 38.20, that to the 0.382 retracement, which is at 9,630, within a hair's breadth of where we touched on Friday. If it can't hold that level, to me, we have very little hope of holding 26.25 in the S&Ps. It's been a leader. It's got an ABC at the moment. We hope that it holds, but it's going to be pivotal. If we can't hold that level on a closing basis, there's something very badly wrong, something that we don't know. And even if the market after that rallies a little bit, it's going to be inconclusive. And to me, it's just time to reassess everything and say the models are right. There is something going on which I don't understand, and it's time for me to get out of the market altogether. So, what did we say last week? We said that the curve should begin to steepen. It is steepening. People are putting money to work in the 2-year, still avoiding the 30-year. To me, that is bearish for the 30-year. Eventually, the 30-year will start, going back up. The budget deficit size will do its work, and that is ultimately bearish even for equities, because that's their discounting factor. Nobody discounts equities with 2 years. They all discount them with 30 years plus. So to me, the money is going into the 2s and 5s, as I said last week. To me, that's not good. Bunds and bobble, as we said, it's impossible to trade them outright, because they are so tied to Italy and what the spread to Italy is. Basically, you're no longer trading bunds, you're trading the Bund BTP spread. Who the hell knows what that is going on? I have no idea what stupidity some Italian could commit in the middle of the night and have bunds 200 points higher in the morning. Just so impossible. But we do know that rates will be headed up everywhere, I think, unless we have this amazing new paradigm in which equities fall apart because we are in a recession. The risk of recession, to me, at the moment for the next few quarters is very close to zero. Could the market be anticipating some event? Possible. To me, it's more likely that we have triggered a whole load of stops and we see what happens. Right, so this is what I said last week, and this is what I add now. 26.25 is the 15 times Blue Angel. If that does not hold on a closing basis, well, God help this market. It will go straight away, I would have thought, to 26 to 25.25 almost immediately. You do not want to be short of vol when that happens, but you do want to be long of vol when should it ever go into the 17s. NQ, I said we'll now hold the double bottom around 6,900. It's actually doing it. It's holding the double bottom, so that's not so surprising. Range 15 to 22. Well, now I'm going to say it's actually 17 to 24. It's no longer 15 to 22. I am more comfortable buying volatility in the 17s. I have no problem seeing that and losing some money, but anything in the 17s I am now quite happy to buy until I understand what's happening. European equities are doing just as badly as the S&Ps. They've stopped doing worse, but that doesn't mean anything, does it? The DAX is now so much lower than 11,450. It'll probably bounce to there again, but to me that is an indication. If you couldn't even hold 11,450, which was such an important level, that is an indication that there is something very wrong somewhere. The dollar couldn't do it, couldn't hold 96.50. I'm not going to touch it until it does 2 closes above 96.50 or at least one weekly close above 96.50 before I'm ready to buy it. 93.63 is still the level that you want to be long of straddles, because from 93.63 you can do anything and very violently. And I still think that this is correct. You want to stay long of Dow, Nikkei against any other market like with high beta like NQ, the S&Ps or Europe. I like the Nikkei. I think people have thrown the baby out with the bath water in the Nikkei. I'll very quickly show it to you. To me, this market has a chance now to actually rally all the way back up to 22,000, where all the more important moving averages are. And you can see it on the weekly. It has a chance to rally up to 22,300, while the S&P does far less and only trades the 2700, 2725 area. I like the Nikkei because it's the only market where the central bank is helping you as opposed to hindering you. So that is another place that I would park my money, and that is on a spread against something like Europe. Thank you very much indeed, and tweet you on Monday.